Welcome to Illuminati Silver. We tell you the truth about silver. It's Friday, the 5th of November 2021, and it's only 8:36 a.m. GMT plus 1. We're very early this morning as we have to be out and about by 10 o'clock. The weather today, dilatory. Yes, it's slow. It's cumbersome. It's foggy just a little. It's cloudy, just a little. We're not sure where the weather is going to end up. It is slow and cumbersome. It is dilatory. And also the Bank of England has been dilatory too, because in spite of expectations of a rate rise yesterday, it simply did not happen. Let's take a look at the headlines. Central bankers plot course through end of easy money minefield. Bank of England's Bailey says it's not his job to steer markets on interest rates. That's an interesting one. We'll take a quick look at that. Bank of England defies bets on a rate hike as Bailey echoes Fed's jobs focus. Bank of England defied market expectations by keeping interest rates on hold, putting its credibility on the line as it chose to prioritise the risks to economic growth instead of inflation. Highlighting major uncertainties in the UK labour market, officials led by Governor Andrew Bailey voted 7-2 to keep the benchmark rate at a record low of 0.1%. The decision shocked traders who slashed rate hike bets and sent the pound tumbling 1.3% against the dollar. Remember that in a few minutes' time. UK government bonds advance with the yield on 5-year debt set for the biggest decline since the Brexit vote. While Bailey said the surge in inflation means borrowing costs will have to rise in the coming months, he pushed back against market expectations for aggressive tightening. Defending his decision, he focused on jobs, echoing similar concerns by the US Federal Reserve. Chair Jerome Powell on Wednesday said he doesn't favour raising rates until the labour market heals further. Well, if you bear in mind that there are literally hundreds of thousands of job vacancies going unanswered because people in the UK have now decided that because of the pandemic they have found alternative forms of employment, or in some cases actually being paid to stay at home is far more, shall we say, favourable than necessarily going out to work. Central bankers plot course through end of easy money minefield. Global central bankers are turning towards tighter monetary policy, yet still indicating they will take longer and follow different paths than investors currently expect. Just this week, the Federal Reserve confirmed it would start slowing its asset purchase program. But Chair Jerome Powell said he won't consider hiking interest rates until the labour market heals further. The Reserve Bank of Australia dropped a pledge to anchor short-term bond yields and signalled it had no plans to raise its benchmark rate anytime soon. The Bank of England defied market expectations by not raising rates, while sticking with the view they will still need to rise in coming months. And at the more hawkish end of the spectrum, Poland and the Czech Republic tightened rates, and Norway indicated it would do so again in December. With inflation strengthening and growth slowing, most policymakers in developed economies face a balancing act in which the risks are almost equally shared between acting too fast or too slow. That increases the chances of surprising markets and committing a policy error. And the Bank of England governor, when chastised for his decision, said Bank of England Governor Andrew Bailey said it wasn't his job to guide financial markets on interest rates, hitting back against criticism that he misled investors in the weeks leading to Thursday's policy decision. Speaking after officials defied market expectations by keeping borrowing costs unchanged on Thursday, Bailey told Bloomberg TV's Francine Lacroix that his remarks on the need to curb inflation before the meeting were conditional. "I don't think it's our job to steer markets day by day and week by week," he said. The comments will do little to ease criticism that Bailey's decision not to push back against aggressive bets of tightening would undermine the central bank's credibility. BBC News, we'll need to rush through this because of the amount of time I've just spent there. Bank of England sorry for rising costs of living. M&S are stating that customers are Christmas shopping early. Well, that's not a surprise, bearing in mind we had a lockdown last Christmas and they're panicking just in case we have one this Christmas. In America, Trump's Russia dossier analyst charged with lying, Igor Dashenko, who worked on a 2016 dossier that made baseless claims about Donald Trump, is arrested. New York's next mayor wants to be paid in Bitcoin, so anyone who thinks cryptocurrencies are dead in the future, well, you better tell the next New York's mayor that that's the case. Biden rejects blame for shock Virginia vote loss. It all comes from the top. Reuters, Jack Ma, Trump and Xi, how the Chinese billionaire flew close to the sun. This was supposed to be Jack Ma's finest hour. A year ago to the day his Ant Group was meant to go public in a $37 billion blaze of glory. Instead, Beijing reigned in his empire, abruptly clipping the wings of corporate China's biggest star. Well, one thing that's not clipping the wings of is the US dollar, which has strengthened again and is now at 94.35. Now, we mentioned earlier that the Bank of England did not raise rates. The one concern that we had about the value of the dollar being slightly undermined potentially was if the Bank of England had raised rates. It hasn't. This now means that it is extremely likely, in spite of all the pumpers telling you the dollar's going to collapse now, the dollar's going to strengthen further because it's involved in a basket of currencies, of which the key ones will be the euro, the yuan, sterling, the dollar. And that basket of currencies, we've already now heard the Bank of England's not raising rates. The Eurozone is incredibly dovish, and Christine Lagarde has done her best to suggest to markets that they're not really going to intervene particularly. And of course you've got Fed Chair Jerome Powell saying we're going to monitor things month by month. So the natural recourse for traders is to move into the US dollar. And this will have an effect on gold and silver prices, which have risen in the last day, but we'll take a look at that in a second. Energy prices hovering around the $80 mark. Stocks slightly mixed, but broadly positive for the S&P and Nasdaq, and marginally negative for the Dow. Asia Pacific down between 0.5% and 1.5%. UK and Europe recovering a little, but it's such a small percentage. Now, today, important data. We have the non-farm payrolls. Now, it's not going to affect the bank's decision on interest rates. That's already been done. However, it will affect traders' views of when there is going to be a rate hike, how soon that will come. I don't wish to over-egg the importance of this today because, quite frankly, it's going to be some months before the non-farm payrolls is going to have a dramatic effect again on Bank of England policy. The issue, though, will be whether they'll increase the tapering or decrease it. And so we're expecting 450,000 new jobs for October. The unemployment rate is expected to be 4.7%, and average hourly earnings 0.4%. We shall see how that pans out. But looking at the initial jobless claims yesterday, they were down, and the continuous jobless claims down. So we are expecting, no guarantee, we are expecting, especially as the ADP report on Wednesday was also positive, figure than 450,000. Gold prices up. 1,800. That's that key level. Has been support and has been resistance. Up $24. We think this is a little bit of an after effect from Wednesday's FOMC announcement. Because quite frankly, now with the Bank of England not raising rates, the dollar is likely to increase in value. So this may temper any enthusiasm in the precious metal space. So we have gold at 1,800. If it rises above that and holds, the next resistance is 1815 and then 1828. On the downside, if it falls, is 1780. Below that, 1768, 57, 50 psychological, and then 1738. This is where we see, between sort of 1738 and 1828, broadly gold moving. Silver, up 32 cents on the day at 23.94. Not quite at the 24 level. You have resistance at the $24 level because that's where the 10-day moving average rests. You then have support at the 50-day moving average of 23.39. Have gold and silver positively reacting to what we termed in yesterday's video the FOMC's dovish approach. We thought it was dovish, and we were a little surprised, in truth, that the US dollar strengthened on the back of that. However, we're seeing the effect today, but now with the Bank of England having done what it's done, any increase is going to be tempered. Give an update in tomorrow's video because we'll have a greater insight into not only market reactions but some of the traders' comments too as to how they view the price of gold and silver moving forward. Cryptocurrency market up 0.25% at 2.73 trillion market cap. That's it for now. Update tomorrow, please don't miss it. Repeated then on Sunday, and a couple other videos that we shall throw in, perhaps looking in a little more detail about the influences on gold and silver prices, which in our view for the next month or so is simply going to be the value of the US dollar. Thank you for listening. Please give us a thumbs up. If you don't like what we say, give us a thumbs down. Subscribe, press the bell sign. Until tomorrow. Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.